We've got Chris calling from Hamilton. Go ahead, Chris.
Good evening, gentlemen.
Hi there.
I'd like David's view on Northland Power. I was considering that for a holding, for my TFSA. I wanted, a good dividend payer, which had, good predictable growth. And I'm pretty heavily weighted already in both Canadian and U.S. banks. So I just wondered whether you would buy Northland Power for your TFSA or maybe suggest something else. Thanks very much.
So, Chris, when you look at Northland Power, which of course is they build and produce green energy in Canada, around the world, very interesting company. Pays a 4% yield, which is very attractive. But the key word in this thing is power. This is part of the utility group. Even though it's a little bit different, it's going to get painted with that brush. And we have to remember that 80% of return is buying in the right neighborhood. Some are going to do a little better, some are going to do a little worse, but you're going to get judged by the neighborhood. And that's the way it is in the stock market, just like it is in real estate. And, sadly, Northland Power is getting painted with that utility brush right now. And it's not to say it's not going to pay you your yield, it will. But you have to know why you're buying it. If your view is that interest rates are going to stay relatively low and that bonds are going to be benign, this is great. But I would say right now the signs are pointing towards higher rates, a little bit higher inflation, and you want something with a little bit more dividend growth as you go along the way. So, I know you say you've got banks. I would have pointed to a TD Bank as a Canadian alternative, similar yield. But I would say maybe you want to look at one of the big mature software companies, that are growing their subscription revenue rapidly and growing their dividend more rapidly than something like this, but also long life predictable assets. So I'll have one for you in top picks. Okay. But I would just be cautious right now. Everybody owns utilities. They've built their positions over the last 30 years during falling interest rates. They could be challenged for a long time.
No problem. Thanks for that question. Henry in Hamilton, let's go to Kevin in Kingston. Go ahead, Kevin.
Hello.
Hi, Kevin.
Hello.
Hi there. Is that Kevin?
Yes. Thanks for taking my call.
No, sure.
My question is on Visa and MasterCard, primarily Visa. It's reporting tomorrow morning. And I would like to know if you're bullish on it. And also, are you not worried about the 10-year bond yield hitting 3%, which might take a toll on the entire stock market? Thank you.
Sure.
Thanks very much.
So let's start with the second question first. Okay. The last time long-term bond yields hit lows was in 1947. The yield in a 10-year bond was 1.6%. Between 1947 and 1966, bond yields went to 6.6 in a 10-year bond. The 10-year return for the U.S. bond market was minus 1% per year. So I just want to let that sink in for a minute.
Over what period again?
10 years, the 1950s.
Yeah.
And then the following 10 years was just a little under 1% a year. So in the face of that, people slowly took money and bought dividend growth stocks. Some right at the beginning, but by 1970, you had the greatest bull market in dividend growth shares in history. They called them the Nifty 50. They traded at 60 to 70 times earnings. So when people say stocks don't go up with rising rates, well, they do. Depends how quickly the rates are going up. If rates went up in a hurry, it would spook people and probably cause a correction. And that's not impossible, right? But my guess is that's probably not what we're facing in the near term. It took 20 years to go from 1.7 to 6.6. I do think it's going to take time. But you do want to own things with a rising income stream and rising interest rates. And stocks can do that. When we bought stocks in the 1980s, we talked to our clients, said, you need inflation protection. Nobody talks about that anymore, right? So I think that's a consideration. Visa. We've owned Visa, I think, consistently over the last 3 years. We have a lot of payments technology companies. We invest in structural themes. People are moving to digital transactions. It's happening all over the world, and they continue to beat consensus. People talk about how expensive some of these stocks are because they're assuming that the estimates that analysts are coming up with are right. And we're being shown quarter after quarter, they're wrong, right? They're too low. So if the estimate's too low, the price earnings multiple is not so high. So I really like Visa. They're the absolute leader in digital payment space. Everybody connects in through them. Could the stock pull back a bit? It could pull back to 117 or 118, where the 50-day moving average is, without any difficulty at all. That would be 6-7%. But that's not going to change the structural theme. If the economy slows down, digital payment is not going to slow down. It's going to continue on. So I think this is something that you can own really through this bull market.
Henry in Hamilton has been waiting very patiently. Sorry, Henry, I think I jumped past you there. Go ahead, please.
No problem, gentlemen. Thank you for taking the call.
Pleasure.
I periodically hear people mention TIPS, T-I-P-S. What is it? Please, how does it work? Does it work? Is this the right time in the market cycle to initiate a position in this sort of inflation protection? Please, could you provide an overview on TIPS? Thank you.
So
that's the inflation-protected
That's
bonds.
right.
Yeah, or
so
notes. Yeah.
Inflation-protected bonds or notes will see the rate go higher as rates go higher, right? So it's got a floating rate that's tied to the inflation rate. You could go out and you could buy the iShare TIPS ETF, TIP. Now, it's not performing like a stock, but it's an income payer. It's going to do better than a fixed rate bond in the event that rates and inflation goes higher, which we believe is likely to continue. So if I had to own something in the bond market, I'd either own a high quality corporate bond with a short duration, 2 or 3 years, or I would own something like TIPS that would benefit when rising rates.
Okay. We're going to be back with David Burrows, President and Chief Investment Strategist at Barometer Capital Management. The topic, North American large caps. The number, 1-855-326-6266.